Hello again. There's lots of questions surrounding the Fed at the moment. Is it patient or impatient? Will it raise rates in June or September? Or actually, do any of these questions even really matter? Well, I've been speaking about the Fed minutes with Erlam from Oanda. There was so much focus on the removal of the word patience, but to me, these latest minutes show that that was just totally irrelevant.
Yeah, absolutely. I think what the Fed really wanted to achieve in the removal of the word patience was simply to get people off the idea that there's a commitment to low interest rates and really focus on the fact that it is data dependent. It's how it used to be before the financial crisis. It's how it should be once again now. The markets don't really need that commitment anymore. I don't even think businesses and consumers need that commitment anymore when employment's at 5.5%, full employment by the Fed's own definition. I think the economy is performing much better than it was in the past, and therefore we don't really need that commitment to low interest rates anymore. So what the Fed really wants to say now is, now that we've moved past this period, let's just focus on the data, and not just one piece of data, not just unemployment, what's wages doing, what's inflation doing. Obviously it's a core part of its mandate, and we shouldn't just be focused on things like unemployment. So I think it was a good removal, but I think the markets have misinterpreted it in a way. They've seen this because the word patience was a commitment to at least 2 months before they raise interest rates. Automatically the markets were looking to June, and I just didn't really understand why. Inflation is low, it's falling, there's still a lot of pressures coming from falling oil prices, and that just doesn't affect inflation. It affects core inflation as well in an indirect manner, because it affects travel costs for companies, it affects food prices, it affects prices of your TVs, for example. It affects everything, and therefore the Fed needs to see how this plays out before it can be convinced that we are going to see these inflationary pressures in the future. So I think the removal of the word patience was good for the markets, and I think eventually they will settle again, but I definitely don't think it means June, and I think people are starting to come around to that idea again now.
Yeah, now people are talking about September, but I still have a problem with that, because what's going to be different in September? There's this focus on also from the Fed that we don't know what's going to happen outside the US, so that we have to be cautious there. But we can always wait for something bad to happen. So is it any more realistic to expect the Fed to hike in September?
I don't think there is really too much difference between raising in September or June. I think September just seems more likely. It gives the Fed a little bit more time to prepare for that first hike. And the impression that I get from the Federal Reserve is, while we don't really need to see an interest rate hike come September, I think there's a number of policymakers there who want to test the water with that first hike, move it from 0.25% to 0.5%, see how the markets react, see how the economy holds up as well. And at the end of the day, if they do hike to 0.5%, there's no reason why they can't move back to 0.25% if the economy and the markets do take a turn for the worse. So I think this is an option that is available, but people seem to have this idea that once they start hiking, the next direction has to continue to be higher, and that is not the case. Now, I think they actually will move in September, I'm not really too convinced. It all depends. There seems to be a very big division between the two sides now. You've got the camp that desperately wants to hike, and you've got the camp that wants to wait and see how the inflation picture holds up. Now that's where we're going to have to wait for the next couple of months, because at the moment there doesn't seem to be a big favourite either way.
There's also lots of focus on the strength of the dollar, that it could be impacting the US economy, but do you think that the Fed's going to start focusing more on the fact that the dollar is strong? I know it's not part of their remit, but do you think there's going to be more talking down of the strong dollar?
Well, it depends what their view is on the strong dollar. There's a number of views out there that the strong dollar is actually good for the US economy. It boosts consumer purchasing power in the US because they import so many goods from the likes of China and the Eurozone and a number of other countries. So there is that view that it's actually positive for the US economy. Then there is the alternative view, obviously, that it's bad for corporates because any profits made abroad are worth much less in dollar terms. So there is really two sides to this view. I don't think the Fed's necessarily going to take the view that they need to weaken the US dollar per se. I think they're more focused on growth, on inflation, and I think in their view then everything else looks after itself. If the dollar is overvalued in the next 12 months, then it's not necessarily their position to move it, but the corporate earnings, for example, will start to show it, and that could therefore weaken the dollar. That's the whole point of the free market. The Fed should not be deeming what is the right value of the dollar. They can highlight it as a risk for potential future for potential growth in the future, but their focus has to be inflation and job creation, and so far the inflation outlook in their eyes is still for 2% within their forecasting period. Unemployment is what they deem to be full employment, and therefore they've got to hope that the US dollar looks after itself, and they've got to look after their job as well.
Do you think that Janet Yellen cares too much about the markets? You were saying earlier that a rate rise, we'll maybe raise rates and then see how the markets react. But does it really matter how the markets react? It's the real economy that matters, surely.
Well, I think all central bankers have to take care of what's happening in the markets. We saw from the S&B back in January that when you see these kind of snap decisions, when you don't feed this information into the markets in the lead up to a big decision like that, and we've got to accept it's been almost 10 years since we last saw the last hike of interest rates. When you feed this, when you're going to take this decision, this can have a big shock on the markets, especially a market which is so overinflated as it is. We're seeing frothing in markets all over the place right now. We've seen moves in China and Hong Kong overnight. In the Eurozone, we're seeing equity indices at record highs. We're seeing bond yields in negative territory across a number of different countries. We're seeing in the US indices at record highs. There's frothing in all these markets right now, and I think if the Fed isn't careful, we could see one of these flash crashes, which can cause serious damage to the markets, as we saw in the S&B back in January. And therefore, in ordinary market conditions, I don't necessarily think the Fed should be too focused on what the financial markets are doing, but these aren't ordinary conditions, and therefore I think it's right for her to be considerate of what the impact of what the ramifications can be on the markets.
Yeah, so let's finish with a look at the dollar. Dollar strength has really been one of the main stories in the market for the past quarter and more, really. Do you think that dollar strength is going to continue?
In the longer term, yes. In the shorter term, I think there could be a little bit of room for manoeuvre. I think it's going to be a good summer for the euro, for example. I think the Eurozone is currently benefiting from the weaker euro, in particular these lower oil prices as well, benefiting it a little. But I think the weaker euro is really benefiting the euro right now. And if you think of like for example, the holiday period, and there's a lot of people now talking about going to Europe for the summer holidays, just simply because it's become so much cheaper than it was before. So I think in terms of the summer, it could be a good period for the Eurozone, and therefore demand for the euro will be higher, and that could help support the euro. In the longer term, though, we are talking about the world's strongest economy, or the world's biggest economy, looking to hike interest rates before anyone else. So it's hard to really envisage no more dollar strength towards the end of the year. So maybe in the next 3, 4, 5 months, a bit of euro strength against the dollar. But beyond that, I think it's got to be dollar strength onwards.
Thanks to Craig there. Stay tuned to Dukescopy TV for more interviews. But from a very sunny and warm London, goodbye for now.